Hey everybody, Scott here with Voak Homes at Pacific Sotheby's International Realty. Hope you're having a great day. It's time to take a look at San Diego's housing stats through June of 2025. And after a long period of softening underlying statistics, but continued increasing prices, we're finally seeing the prices turn down. Stay to the end of the video. I've got two pieces of information for you. One, I was able to grab some statistics that are not readily available that show the percentage of homes that are failing to sell, and that's a pretty big story this time. And also I'm going to give you my thoughts on why I think the market may be in for a sustained downward trend, and this is not the same thought that I have had in the past. So let's take a look. Once again, I'm going to focus on the detached homes, but this month I'm going to show you a little bit more information on the attached homes to show you that the trends that I'm seeing are across the entire market. So after several months of continued increased prices, even though the underlying statistics were weak, the detached pricing did move down last month, and the median price is now 1% under where it was last year. So that's a year over year, pretty much even, but down just a little bit. The average came down a little bit harder. That just means we're selling fewer of the higher end houses, and we're now sitting 6% below where we were last year on the mean price for detached homes. And just so you can see that that's holding true for attached also. The attached didn't come down as hard on the average. The median came down a little bit harder. I have some thoughts on what's driving the attached market, and I'll cover that at the end of this video. For the underlying statistics, I'm going to combine the whole market. So we're looking at all homes sold through the MLS. You can see for the second consecutive month we had a reduction, and we were actually almost 1% below the rate of June last year. The thing that concerns me here is I don't like to see a reduction in sales in the summer. That's just not when we normally see a reduction, and so that has me a little bit concerned. Similarly, when we look at the pending sales, the homes that are in escrow, those were down last month, and we're now 5.5% below where we were last year. So the pending sales are down more than the actual closings, which kind of means going forward next month we're going to have a reduction in closings again, and this just doesn't bode well for the underlying strength of the market. Fortunately, as you can see here, new listings also fell, so that keeps a little bit of the pressure off the market. The combination of reduced sales and reduced new listings in this case happened to be a slight increase in overall inventory. However, piled on previous month's increase, we are now 33% above last year's inventory level at this time. Let's take a look at the statistic that combines the active listings and the sales rate, and that is the months of inventory, and that gives us a really good picture of where we are. As you can see, the months of inventory has increased every single month since December. Not something you like to see if you're a homeowner. We are now sitting at 3.5 months of inventory, which is pretty high for San Diego, 30% above where we were last year. To give it some perspective, let's take a look at a longer chart. You can see we're still way below where we were during the crash, but nobody wants to get to crash levels. So we are starting to climb up to a point where we're seeing softness in the market price. So this chart doesn't look near as pretty as the other charts, and that's because I had to create it myself. I dove into the MLS. This is San Diego MLS data as of July 8th. And what I did is I pulled out all the failed listings. So that was listings that canceled or expired prior to selling. And I wanted to see what kind of change we've had and if that would potentially lead to lower prices, because up till now we've seen sellers take homes off the market and not reduce the prices. However, if you get more and more people failing, eventually somebody's going to cave, and then you start seeing a cascading effect. And you can see from this chart through 2020 and most of 2021, we literally had effectively 0 failed listings. Some months it was 0, other months it was 2 or 3. That picked up as we hit the end of 2021, coming out of the COVID situation. And you can see it really spiked up here in late 22, early 23. This wasn't so much because there were a lot more expireds and canceled. It was that there were so many fewer listings at that point that on a percentage basis it was higher. So this purple line is the total number of failed listings divided by the total sold listings. The blue line here is the total number of failed listings divided by the total number of active listings. So I think the purple line is a little more indicative of what the market's doing, because that is where the listings have hit a resolution. Either they've sold or they've failed. And so I think that's a little more accurate than saying they failed or they're still on the market. The key point I want to make for you agents and especially home sellers out there is right now, for every 3 homes that are selling, 1 home is failing to sell. So it's no longer can you just put the home on the market, put it on the MLS, hope it sells. You've added for a sustained period of market softness and pricing reductions, where I think over the next 3 years, I think we are set up to see the market gradually fall. I'm hoping, and I believe it won't be a dramatic drop, but it'll be enough that you'll look back in 3 years, and if you were trying to sell now or in 3 years, you'll be happy you sell now. So on the supply side of housing, we currently have 1.2 million dwelling units in San Diego County, but they've greenlit a lot of apartment complexes. You drive through Poway, you drive through Miramar, even areas in North Park, and you see these new buildings going to go up. They're going to add dramatically to the housing stock. Additionally, we have a large number of ADUs. In fact, enough ADUs going in that it's becoming a controversial subject. So the supply of housing is increasing. The other side of the equation is the demand. San Diego has about 3.2 million residents for that housing. Of those 3.2 million residents, however, slightly over 200,000 are unauthorized immigrants as of the end of last year. That's 6.5% to 7% of the population. That is being dramatically reduced. If you are looking for property to rent, or if you own property that you're trying to rent out in the areas that are immigration heavy, City Heights, Logan Heights, those type of areas, you know that rents have fallen by about 10 to 15% in the last 7 months. The tenants just aren't there. They've left the country, they've self-deported, or they have been deported. Not all of them, but enough that it has caused a dramatic drop in rental rates. As rents in City Heights drop, it's going to affect rents in North Park. It's going to affect rents as far high as Miramar. If you are somebody thinking of buying your first home and you're currently renting and you're watching the rental rates fall, at the same time, everything you look at on YouTube or whatever your social media is telling you there's going to be a housing crash, and you say, wait a second, interest rates are 7%, maybe 6.5%, rents are falling, housing prices may come down. That is causing softness and will continue to cause increasing softness in the lower end attached portion of the market. Well, if the attached portion of the market isn't moving, the lower end, the people that in those units who want to buy houses can't move up. So it has a ripple effect. Hey, thanks a lot for watching the whole video. I really appreciate it. Hope you've learned something. In brief summary, I think we're headed into a 2 to 3 year period of sustained downward pressure on pricing. I think the inflection point was June, and I think it will just continue. Reason being, we're adding more housing stock in the form of apartment buildings and ADUs. At the same time, we are losing a lot of the bottom end of our rental market due to deportations. We're also, for some reason, seeing a lot fewer students renting places, and that could be student visa issues, but there's a lot more condos for rent in the UTC area around UCSD than there ever have been at this time of year. So the combination of those two, along with people just fed up with California, high cost of gasoline, high cost of electricity, high cost of everything, and when they don't have to live here, the kids are done with school, a lot of people are leaving. You take all that in, and our population is coming down. We have been fortunate in San Diego that we've picked up population from the Bay Area and Orange County as high-tech companies have moved down here and people have moved to San Diego because it's been more affordable. That is not happening anymore at a fast enough pace to offset the deportations we are seeing and the people who are vacating to follow wherever their kids moved and the grandkids are, or just for cheaper lifestyle. So I'll be back next month. We'll take another look. Thank you very much. See you again next month.